Okay, let's keep up, be mindful of our mics. And they are based on a possibly volatile equity index. Now, beyond the death benefit offered, IUL policies shouldn't be considered optimum retirement savings vehicles. I'll say that again. IUL policies shouldn't be considered optimum retirement savings vehicles. A 401k is a better option for that purpose. So that means if you're looking for your retirement, if you're talking about something to build your retirement accounts, I wouldn't just say IULs. IULs is mainly for those who are affluent and wealthy because they recognize that when they're making these investments, they're not necessarily using this policy just to worry about, okay, which one of my grandchildren is going to get the death benefit. They're making this investment because they recognize it. They're moving and shaking and they're figuring out ways how to get more assets that they can own. The more assets you own, the more that they're producing some level of wealth. That means, and then when that resources come in, you send that money out so they can get more pregnant. And that's how you start seeing how some of these astronomical, values of what people are worth end up happening. And you can just be like one of those individuals as well. Who says you cannot? Because a 401k is a better option for that purpose because it doesn't carry the high fees and premiums of an IUL policy. Plus, there is no cap on the amount you may earn when invested. That's a 401k. Same thing as a KEO. The KEO, you heard what Ms. Johnson stated, which as she shared the research, usually is up to $69,000 per year that you can put in a KEO. That's why usually they position KEOs for people who are, in that realm of, as an entrepreneur. And if they're really making a whole lot of high value money, then not only do they have one KEO, then they may have another one. Yes, Ms. Johnson.
I just wanted to correct that. The 2026 max contribution is $72,000.
Oh, come on. Thank you. Look at that. I mean, you can add some more money to be tax deferred, even though you're an entrepreneur. Thank you for that update. That's good. That's good. It's always good to get clarity. See, we'd be so stuck. Oh my God, we heard 69. And be so stuck on it. Oh my God, now we hear 72. Like, wait a minute. Get your mind out of the box. Get out the box. You're not meant to live in a box. Cats love boxes. You're not a cat. Get out the box. Most IUL policies are best for high net worth individuals seeking to lower their taxable income. That's why when you hear individuals of high net worth have these type of policies, and then they borrow against that cash value, and then most times, if they're wise, which hopefully they are because that's how they became a high net worth individual, they're taking that ability to tap into that cash value that's accumulated to look for other asset and money making possibilities. Let's say I want to go on vacation. Oh, I'm going to go borrow because I want to go on vacation. That means you didn't plan. You really taken out of your regardless of his whole life, regardless of whatever the vehicle is, just I need money to go on vacation. No, that means you didn't properly prepare. We got to deal with your mindset. That money should have been already allocated. Your money, don't tell me that you're taking money out of something that should be growing just to have a moment. No, you should prepare for that moment. So while you're enjoying that moment, you can be in Bora Bora or South Pacific or in Europe and Paris or whatever place where you're choosing to be, or somewhere in Singapore, wherever you're choosing to be. Your money's still working without you having to push it. That's when it goes back to mindset. And that's why most times these type of policies are not offered. And it sucks, and it's another form of redlining, but they know that this is an area that's not really high net worth individual. No, we're not going to waste our time. Because as Miss Johnson alluded to, and going to something that Mr. William was asking about, we have 3 different levels right here in the spectrum on this wonderful graphic. comparing the universal life policy. Now, mind you, as Ms. Johnson was able to find this graphic, this is about having $1 million worth of coverage. Now, if we looked at fixed universal life, and we're dealing with safety versus speed spectrum. Now think about that, because sometimes we want stuff so quick. We in this microwave age. And I love technology, and I'm happy I'm a Gen Xer, but I remember when things were a little, way before, and that's why I'm happy I actually experience both sides. I love the technology, but I remember when I had to go to 173rd Street in the Bronx and go to the library. I was looking for a book to do a book report from one of my teachers. Or go to one, there used to be an A&P, Atlantic and Pacific Tea Corporation, A&P. And you'd be thanking God when it was that time of the year when they were selling the Britannica Encyclopedia or Funk and Wagner's. And each week you would be going into the supermarket because you waited till that week's volume was on sale. Because then the other weeks it would be higher. And actually, you felt proud when you had the whole set. So think of it that way. So fixed universal life, the first one on the left, that's in green. Fixed universal life, the savings account, slow and predictable. How it grows as a declared 3 to 4% fixed rate. The safety net, guaranteed principal, minimum rate, safe from market crash. So that means that this one, the market crash, this doesn't affect you. Because they already declared the fixed rate that they're going to grow per year, even though the insurance company could be making 10, 15, 20% on the money. But they're guaranteeing your 3 to 4%. So it's a nice chunk. Primary profile, ages 45 to 70 plus, with an average income of 30K to 100K. Simple estate planning and mainly for final expenses. So as even Mr. Richards was talking about, sometimes we see the commercials talk about, certain insurances that are, offered, those are the type of ones that they're looking at. Monthly premium for $1 million, minimum $250 per month. That's just to keep the lights on. So that means if you have that type of policy, if they ask for $250 a month, that's just basically bare minimum. The target is to be doing at least $500 a month. And you notice that it says to age 100 plus. That means the earlier you get in, the less your premium is going to be for $1 million policy. And of course, the older you are, the higher the premium is going to be. So remember, this is also based upon, don't just take this as the end all be all. It's always going to be based upon your age, probably certain other factors that come into play. And then the max is $1,500 per month for real cash accumulation. So you're giving you different scenarios for if you desired $1 million worth of coverage. We're not talking about term here. We're talking about things that you're able to, you need something, be able to borrow from. Now, internal fees, 5% premium low, standard monthly COI, that's cost of insurance, and usually administration fee of $10 a month, which is usually included in your premium. So when you send in that premium, your premium doesn't automatically all go to, all those respective things. Remember, they're in business. Whatever your premium is, your monthly premium is, you're paying into that. The catch, inflation risk. Growth may be slower than rising costs. So that means, as you see that 3 to 4% up top, if inflation is kicking around 5, 6, 8%, yeah, you have a death benefit. But by the time it's time for you to cash out, it didn't grow with inflation. So it's just something to think about. It's not making it a bad thing. It's not making it a good thing. It's just something to think about. Now let's go to the middle. We're in the blue. Index Universal Life Insurance, as we've been dealing with for the past couple of weeks, IULs. The middle ground. Safe market exposure. How it grows. S&P 500, Dow Jones, and linked index performances. Could be different ETFs, different things, whatever. The safety net, 0% floor and cap protection, safe from crashes, but limited upside gains. Because remember, they're still working in they're still in that space where they're dealing with different indexes. Insurance company has no control over the movements of the markets. The primary profile, ages 30 to 55. That's why we say something like this would usually be better for someone who's younger. Average income, usually for this type of profile, is a person that's making 100K to 250K, building tax-free retirement bucket. For the same $1 million, if they tell you, you can send $400 a month, okay, that just covers insurance costs only. The target is usually at least $1,000 a month. That means you have a moderate growth cushion, as you can see by the different graphs it's showing you. And max, your max funding and overfunding, $2,500 to $4K a month. That's why in a lot of our zip codes and communities, you won't see this. Because usually if someone's willing to get to the point to say, you know what, I'm going to do the max, so anywhere near the 4K plus, that's usually someone's, as we've noted, someone's mortgage payment. That means usually something like this is not good for someone who has a family, this, that, and a third, and blah, blah, blah. Or if they do have a family, they better be making the type of average income or more to deal with having this type of policy. The internal fees, they're moderate. 8 to 10% premium load, as you can see, almost double the fixed universal life. Cost of insurance and index strategy fees. Surrender charges after 10 to 50 years. So that means with the index universal life, that's another caveat. This is something that you should be looking at, that depending upon where they said the surrender charge is, that's where you can get into the fold of owing the IRS money. Now, after, say, if you held it for 16 years, then there's no surrender charge because now you went beyond the threshold. Flat markets, flat fees, eat cash value during 0% years. So that means those years where you get the opportunity, or they say, you're having a lean year, you're not really paying towards this. We got enough cash value that, that'll cover some of your premiums. But at the same time, you don't necessarily should desire to do that. Let's see. Is there a different tax rate for deferred payments? Not necessarily, because if anything, when it converted, like when you owe the IRS for taking, say, like if you have a regular IRA, you take it before the time of your retirement, they usually charge you that 10% penalty, and then usually you're going to get some sort of 1099 from that, regardless if it's insurance company, investment company, wherever it is, to show that you took this money out and now it's considered income. Now it gets taxable at your income rate. So whatever your taxable rate is as an individual, that's where the IRS is going to be looking for, or the state, regardless of how your state works, looking for their cut. Because you didn't take this as retirement income, you took this as pre-retirement. So that means you took the money out for stuff that was pre what you had designated for. That's why they charge you those premiums. So wherever your taxable rate that the government, when it's time for you to file your taxes, says that this is your taxable rate, that's usually where you get taxed at. Great question, Karen. Now, we're going to variable universal life, which we dealt with a couple of weeks ago before we dealt into index. Let's see. Post-retirement now. Post-retirement, the only reason why, if you're starting, like if you have like an annuity or things of that nature, where it may affect you is in your Social Security. That's where they started playing with the numbers. Like back in the day, Social Security wasn't necessarily taxed, or your benefits wasn't necessarily impacted because you had all this other stuff over here. Nowadays, they started changing up the rules a little bit. Whereas, if anything, there is a floor where depending upon how it's considered as retirement income, that you can have the opportunity to still pay the government a part of it. So yes, there is a part of it, but at the same time, it all depends. But that's when you have those conversations with your tax professional. If you have an accountant who can actually tell you exactly what it is and how to play the game, because there's high net worth value individuals who still access their Social Security. Because once you turn 65, you automatically have to go towards Medicaid and stuff like that. Certain things that are mandated as a citizen. So, that's when but high net worth individuals have their, tax attorneys and tax lawyers and all the other stuff and trust and that. You start figuring out how to still own stuff, but don't have stuff in your name. But we'll get to that as we continue down this path during the course of this year. So variable universal life. We're now in the orange. Stock market, high risk, high reward. We went from slow, predictable to safe market exposure in the middle. Now, as you can see, it's almost as if like we're in some sort of Formula One car. How it grows, direct mutual fund investments. Safety net, ain't got no protection. Full market exposure. That means if the market is doing good, boy, you are sitting there feeling like you just throwing money in the air. If the market is not doing so good, as it says, full market exposure. Are you willing to move in that risk? Primary profile, ages 35 to 55, 230K to 300K plus. Aggressive tax sheltered wealth building. Usually minimum $500 a month, highest risk of lapse. That means they're already letting you know. You're only sending $500 a month. Okay, yeah, you're able to you're basically barely maintaining this type of policy. You're doing $1,200 a month for this $1 million of coverage, recommended for stability. That means because it's being exposed to the markets. It's looking for those possibilities, looking for those growth areas so it can make some money and come back pregnant. Or the max, 3K to 5K per month. As we said, usually, depending upon the zip code, that can be someone's rent, someone's mortgage. Are you willing to have something that you're just paying that per month, which gives you the opportunity to access it? The cash value is accumulating in a very positive and powerful way. The internal fees, as we saw from fixed and index, we went from internal fees were low over here. Index universal was moderate, 8 to 10%. They let you know the internal fees are 10% plus the cost of insurance plus a 1 to 2% fund management fee. Highest administration fees. Why? Usually these variable universal lives, if you are with the Goldman Sachs and the different brokerage houses and stuff like that, the different names, they're not giving us any promotion here, so we're not going to start throwing out names. But those type of brokerage houses usually have these type of things that they'll offer some of their clients. Because if their clients are high net worth value clients, they're already exposed to the market. Why not have this type of life insurance or this particular type of policy? Why? Because they're willing to, if they're in that target or it's definitely in that max range, and all of a sudden, there's a little, downturn that happens, or they're looking to not go to a bank to look to borrow 50, 60 grand because they have an opportunity to invest in something that may have a nice piece of return. Wait a minute, I can tap into my cash value from this particular thing that's already, I'm already paying these high fees and stuff like that. And I'm gonna draw some of this money out, go invest it in something that I can build another asset around. And if I'm being wise and I'm picking the right stuff and everything is growing around me, not only is this working, but that's working. And then something else behind me is working. Something in front of me is working. And that's how the wealthy and the affluent stay where they're at. Now, as it shows on the bottom, two cars look like they get in a car crash. Implosion, market crash, and high fees can cause policy lapse. It means you're praying that we don't have an 87 stock crash. Or like when Obama came in and we were almost going back to a depression like the 30s. And he had to maneuver and do all this stuff. That we were already in recession. Then we went to the point where people were walking away from houses and stuff like that, and they had to rebuild back the economy. Yes, the markets got real, real low, depressed. But thank God it didn't stay there. To the point now, hopefully this orange man that's in office is not trying to implode the markets, because the markets were doing excellent until this man got back in hope. But like I said, I'm gonna get off my soapbox. Get off my soapbox. There's a lot of people not liking these decisions that are being made because it shows no prudence, it shows no common sense, and it shows no business acumen. And I can't wait for the day when they finally tell him he has to refund those tariffs, because that was just an unnecessary tax on everybody. Go ahead, Ms. Johnson.
Yeah. Mr. Richard asked about long-term care. The variable universal life, that is the option where you can buy a rider, which is an additional item you can add to your insurance policy so that it will cover long-term care. But of the first two, I didn't see that as an option. But for the variable universal life, you could, but of course, it's going to be extremely expensive.
Exactly.
That,
Unless you got that rider early on. See, everything is about the timing. And as we recognize that time waits for no man, it's all about the timing. By the time we start getting exposed to the information that can be beneficial for us, we start sitting there and kicking ourselves, but we can't necessarily kick ourselves, because then it goes back to the fact, were you exposed to this information? Were you privy to it? So you can be ignorant of something, and then we can prove that it's not that we can call it ignorance, is that you just was unaware. Then it's like, okay, now you just have to deal with it now that you have the knowledge. But usually now, as we get exposed to certain things, you start to recognize, like, no, what would you advise someone who's blah, 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 says, look, you're 30 years old, like in the middle, yo, go get you an index universal life. Or if you know that you're in that space where you're making, $250,000 a year, yo, go get you a BUL. You're young enough. You like to be in a space where you're a risk taker. Allow your money to go out there and risk, because high risk, and that's why it says high risk, high reward when we talk about the last one. If you're willing to position yourself for that reward, scared money don't make money. Scared money does not make money. So as we start to come to the close of this,
yes.
and this gives us a possibility of recognizing. And that's why I love the fact that it's breaking down in layman's terms and common fees. We're not attempting to share this from a space where it's like, oh my God, all this terminology and this and that. No. Let's be straightforward so you can recognize, you can make a informed decision. An educated consumer is our best customer. An educated individual who's a part of the Comeback Collective Circle is our best community member. Because now you have to make the decision about, okay, where am I at in the scheme of things? What is it that I desire to do? Am I relegated to a box, or am I expanding out of a box? Am I positioning myself for growth? Not, do I want something slow and predictable? Do I want something where I'm, kind of warm, lukewarm, warm tea? Or do I need my tea hot? And you have the choices from these variable, different examples and possibilities. So,
Yes. Dr. Croft. Dr. Croft.
yes, go ahead.
Yeah, what I'm looking at is actually the saving account. I thank Ms. Johnson for the answer she gives. Accepted. But I'm looking at the savings account. You know, when you look at banking institution, right? You pay more, like say, if you put like your money on a saving, you pay more for administration costs, finances costs. All those things come out in. It's not investment, you know. Just this is just an observation. It's not investment, but they have like fixed tariffs within the banks that they normally take from clients, and then when you look, the clients sometimes end up like with nothing. And also you look at the tax, right? Because normally like taxes like made like abroad, like let's say I'm drawing a reference the USA, and they have like a tax fix rate man that you could go to a certain limit, and anything above that they don't accept any declaration of the taxes. I mean, here I'm talking about this country, St. Martin, that side. So it's like it limits you, you know, for let's say, for instance, investment and the tax payment abroad, returning back here, because it's only still, let's say, for instance, if you get like let's say 100, like 100 tax declaration, let's say I'm just drawing reference, and then here only has for 20, you lose 80. So those things, you know, sometimes it's like the tax fixed rate that they have for taxes here, you can't go over that level. Before time, yes, but now they adjusted. So the tax fixed rate is like a no-no from taxes coming from abroad. Just an observation.
No problem. Yeah, that's why even like certain like the Grand Cayman and certain tax shelters in the Caribbean, and people say, you know, why you got your money in the Cayman Islands, or why people have a Swiss account and stuff like that. You know, those are conversations usually for people in high net worth situations because they're looking for areas for, how's the best way to say it without it sounding condescending. They're always looking to pay as least amount of taxes as possible. That's why they said the middle class always gets squeezed. If you're in the middle, and these days, people in the middle could be making six figures, low six figures. Like, wait a minute, I make 100,000, I make 150,000 a year. You're middle class. You're the people that are getting squeezed, especially if you work for a corporation or you're some sort of middle management and stable and stuff like that. You're middle class. Whereas maybe 20, 30 years ago, 150,000 would have started to put you towards the realm of at least starting to become rich and hopefully moving towards wealthy. Everything changes, and that's why it's always good to be abreast of what is happening from a socioeconomic standpoint. And that's why inflation can eat away at your possibilities, because you may be thinking one way. It's like, oh yeah, I got this nest egg. And it's like, did it keep up with inflation? And if the answer is no, yeah, you got something, but you know, if you have 75%, if what you have is worth 75 cents on the dollar, where the dollar is here now, that means there's a shortfall. And it's not that there's a shortfall from the fact of that the people did wrong by you. It didn't just keep up with the adjusted rate of inflation. That's why people here in the United States who have Social Security ever so often, every year, when it's time for them to get their recalculation of their benefits, they usually get that, you know, that adjustment, which is an inflation adjustment. It's like, okay, inflation was moving at 2.6%. Okay, you're gonna get 3% more this year, so at least your money can keep up with inflation. Because if it doesn't, if it just stayed flatline, all of a sudden, you know, they're getting the same money per month, but prices keep going up. And that's what's happened here, really socioeconomically, globally. Whereas people have been making, you know, a particular level of income, and if it's still just at that particular level, but prices are going up and you can't even afford a gallon of milk, you know, there's no balance. But those are some of the things that we definitely going to get into over the course of the year. And as we start to bring this to a close, because I love to respect people's time, and I hope you got some great value out of this. Always give you the opportunity to support the platform, and definitely the circle, because we keep reinvesting, keep not only getting the information, but recognizing that, it does take finances to keep this thing rolling. So, if you do it via Cash App, $ Gregory Clark D Min. You choose to support this platform via Venmo, you can drop the $. Just go to Gregory Clark D Min. Or if you choose to support this particular platform, which we use just for outreach and advertising, Zelle or PayPal is the same email address, esquire971@gmail.com. And then also for those of you who are looking for a great AI tool, here's my affiliate link. If you're looking to create videos, get into ChatGPT, Claude, things of that nature, and without having to spend as much or look like that you have access to different tools, definitely go to this website, galaxy.ai, !REF equals Gregory. Use that link. And that's also a blessing to the platform. But on top of that, it's about recognizing that you can get access to the tools globally that can accentuate and add value to what you're doing. Because AI is not going nowhere. Technology is not going anywhere. Now, the person who knows how to utilize technology is going to replace you. But if you keep yourself abreast of what's going on, then you won't be replaced. So that's my affiliate link. Hopefully you take advantage of that and make the investment in yourself. It's worth it. You have to make investments in yourself. That return on investment is so important. You'd be surprised. Some of the stuff that you have access to, especially on this platform, where, I make my videos now, I'm updating my thumbnails and all kinds of stuff, just all kinds of stuff that you have access to. So go to galaxy.ai /REF equals Gregory. You type in that affiliate link, you sign up, you'll be a blessing to the Comeback Collective Circle. And with that being said, until we come back next week, same time, same space, this is Dr. Gregory Clark, seeing nothing and desiring for you to be aware, to continue to grow, and continue to experience. So see all of you next week and have a great week.
Grace and peace.
Have a
God
great
bless.
week.
Great
Great week, everyone.
Amen.